Hey everybody, Danny Murphy here with Danny Murphy and Associates at First Team Real Estate. I just wanted to chat a little bit today about the market. I've getting a lot of questions from clients and then just people in general, like what's going on in the market, right? A lot of people have a lot of different impressions and opinions on the market, and it's definitely shifting. It's slowing down a little bit to more of like a normal pace, I would say. The last 2 years have been pretty crazy, and it's been really tough for buyers. But we're starting to see, that shift a little bit. We still have really low inventory. Inventory has tripled since, January, but it's still about 60% below what it normally should be at this time of the year. So it's all relative, right? So, people ask if the market's going to crash, or are we going to see a big adjustment in prices? And I really don't think we will. It's because there's just not a lot of inventory, right? So if there was a ton of inventory, then we could see prices come down, but there's not a lot of inventory. So it's just a supply and demand factor that is still at play. There's still a lot of demand too. And rates, when you really think about it long-term over the last like 60 years, interest rates are still at, really, they're well below the long-term average the last 60 years. Which is over 6% average over the last 60 years. So, at 5 and 5.5, we're still seeing really good interest rates, and they're much lower than they have been in the 70s and 90s and other times, right? So I think that it's all relative. So I don't think you see a crash coming, but the other thing too that we've been telling people is you're not buying the house, right? Sorry, you're not buying the loan, you're buying the house, right? So people are gonna. How many people do you know that have stayed in the house for 20 years? A lot of times people are selling after 5, 6, 7 years. And then also, people refinance their loans. So, this is what I call the payment dropper post. I said payment dropper post. A lot of times people are buying right now with an adjustable rate mortgage. Those had a bad reputation back during the Great Recession or before that, because they were negative amortization, they weren't good loans. People were, wasn't paying down the principal. Well, the loans now are really good loans. So an adjustable rate mortgage with like a 7-year arm, meaning it's fixed for 7 years, or a 10-year fixed, and then it adjusts after 10 years. Those are great mortgages to get. You get a lower interest rate. And then with that lower interest rate, you have more purchasing power. And chances are in the next, probably 2 years, I predict in the next 2 years, rates will be back down quite a bit from where they are today. Not where they were a year ago or 6 months ago, but they'll be down. And so I think you'll be in a position where you can refinance out of that 7 arm or 10-1 arm and buy get a 30-year fixed rate. But in the meantime, don't let, the rates having moved up a bit stand in your way. So this is your payment dropper post on things to think about. Get an adjustable rate mortgage. You're probably not going to have the mortgage for more than a couple years anyway. So anyway, just wanted to share that. Hope everyone's doing well out there, enjoying the start of summer. Danny Murphy, if you have questions, call us, text us, email us, go on social media. We're here to help. Thanks. Bye.